Will 2025 bring another sluggish year for housing? How might Trump's policies shape the market? And could the Fed lower interest rates sooner than expected? Yahoo Finance spoke with experts and analysts to discuss the latest economic data and its implications.
U.S. housing starts slowing in January as builders pull back on construction amid fears and growing fears over high mortgage rates, affordability challenges, and unsold homes. New construction fell nearly 10% to an annual rate of 1.37 million homes, falling short of Wall Street's estimates. Here with more on the state of the housing market, we've got Danielle Hale, who is the chief economist at Realtor.com here. Great to have you back on the program. So first, just walk us through some of the dynamic here that we're seeing in new construction.
Yeah, thanks for having me, Brad. So in the new construction market, as you mentioned, there's some uncertainty that builders are experiencing right now, and we see that reflected in the data with that pullback in starts. Now, there are a couple of good things happening in that data. One is that completions ticked higher, so builders seem to be in get-it-done mode, trying to close out construction projects that are already underway. That will near-term boost supply, which will be good for buyers, but will make it a little bit more challenging. Builders will have to compete with each other to get rid of and to sell that inventory. Looking further ahead, as you noted, starts are down. That was pretty much in both single family and multifamily types. But looking at the permit data, which is about what is, even further into the future, we saw that data was roughly flat. So not quite as bad as you might expect, given the concerns that builders have about buyer traffic and tariffs and costs down the road. But they're sort of taking a wait and see approach, getting the permits, holding some optimism for the future, but not quite moving forward with projects, perhaps until they get a little bit more certainty.
And so with that, there is the uncertainty of what the cost could be, because we're already at some of the record high prices. And so now, if we did see even more costs that have to get passed through to potential buyers, how are we essentially running the calculus on how much higher the costs could go for potential buyers as well?
Yeah, I think costs have actually been a challenge for home shoppers in the market. New homes have done a better job of being flexible, so builders have targeted smaller footprint homes to help bring down those costs. But if their costs rise as tariffs go up, or if it's harder for them to find workers to build those homes, they're certainly going to try to pass those costs on to consumers. And with mortgage rates remaining very close to that 7% horizon, it's going to be challenging for them to do so. So I do think that puts builders in a challenging position, and that's why we see some of that hesitation in the starting activity.
Danielle, while we have you, I want to take a quick pivot. On the show yesterday, we discussed best practices for buying your first home. And today, we want to talk about moving out of your starter home and into your next one. Maybe you have a family and you're now shopping around. So talk to us about how your mindset shifts from starter to second home, and perhaps give the folks at home some tips for their shopping journey.
Yeah, absolutely. So I think going from a starter home to a larger home can happen maybe sooner than people expect. There's survey data that shows that often people expect to be in their first home a bit longer than actual sellers indicate they're in their first home. But it's great to be able to make that trade up. It's a bit of a challenging market to try to do that right now, but there are some things that consumers can keep in mind. The first, I would say, is to be aware of what are your non-negotiables. Is the school district the most important thing for you? Are you more interested in size and space or proximity to the office? Whatever your non-negotiables are, figure that out and lock it in up front. It'll make it easier for you to make trade-offs down the road, because we know that consumers have to make trade-offs. The other thing to consider is being willing to buy during the off season. You'll get better pricing. You might sacrifice options. We do see more for sale homes in the peak spring season, but you'll get sellers who are potentially a little bit more flexible if you're buying during the shoulder season, which is typically in the fall. The other thing that you want to do is focus on the things you can control. You cannot control inflation. You cannot control the Fed policy and what's going to happen to mortgage rates, but there are things that you can do to get a better rate for yourself. Those include improving your credit score, lowering your debt to income ratio by either paying down debt or trying to grow your income, focusing on your loan to value ratio, either reducing the price of the home you're looking for or making a larger down payment. And finally, the thing you can do the easiest is shop around among lenders. All of those things can contribute to a lower mortgage rate, regardless of what's happening in the market.
Is there a sweet spot right now for the down payment that people should have saved up?
It's going to be different for everyone. The larger the down payment, the lower your monthly costs. But, I think we see a lot of repeat buyers in the 13% or so range. That's about the average. So that's a good target. Of course, if you've seen some nice price appreciation in your starter home, you might be able to put a larger down payment. And that certainly makes those monthly costs lower going forward, which is a nice help when rates are high.
Speaking of heating up, inflation seemed to heat up in the month of January with the latest reading on the Consumer Price Index. Producer prices came in a bit better, offering some hope for your favored inflation gauge, PCE. But given that inflation spiked in the first quarter of last year, and now we're seeing the uptick again in January, given that there was hope we would see easier comps that would provide some progress on the inflation front, to not see that now, are you worried that inflation is indeed heating up, or is this some sort of seasonality we're seeing at the start of every year?
Well, let me start by saying I get paid to worry, so I worry all the time about everything. I will say that with inflation, one of my expectations for a long time has been that we would see progress from the very high levels that we had in the middle of the pandemic, and that's exactly what we've had. And then once we got to September and we were getting closer to our 2% target, I didn't expect that the progress would go in a straight line. So bumpiness and a data point here or there that might send a different signal is not something that's super surprising to me. I think the biggest question right now is whether that data point represents a new trend or just a bump in the road. And that's what me and my team will be looking at over the next several months to make sure that we draw the right conclusion from those January numbers.
Yeah, and that January reading came before any tariffs or any changes in policy. And the minutes released from your last policy meeting this afternoon with a 3-week lag showed that you and your colleagues are worried about potential changes in policy, whether it's tariffs or immigration, and that could pose a risk to higher inflation. How are you factoring that into your outlook for inflation?
Well, look, I think that's a very good question, and I'll just say it's very difficult to factor all of these potential changes in. And I want to emphasize the word potential. For many of these policy areas, we don't have a final policy in place. So right now, we're just kind of trying to keep our eyes on the ball and make sure we understand what's going on. Until that's the case, though, I had an outlook that 2025 would proceed at a very positive level. We'd see solid growth. We'd see inflation continue to move to 2%. We'd see labor markets stay solid. Now, all this potential change, though, means that the confidence band, the precision of that estimate, in my mind, has reduced somewhat. And we'll just have to see how things play out over the next 3 and 6 months. And as we get more clarity on exactly what the policies are, then I'll have a better sense of what's going to happen in the economy. One thing I should also emphasize here is that in addition to some of the policy change that people are expecting might be inflationary, there are others that could go the other way. For example, we've heard a lot from my contacts about the prospects of deregulation, spurring a lot of investment that could increase productivity in ways that could show progress in terms of growth without putting that pressure on. So the details are actually going to matter here, and that's really what I'm going to wait to see.
I know you just said the details are going to matter here, and we need to look at the holistic picture. But to be sure, as the minute said, you are looking at these policies and think they could potentially push inflation higher, correct? Yes or no?
They could, and they could go the other way as well. It's really the whole mix because, again, I've talked to a lot of business leaders who are quite optimistic about what's going to happen on the regulatory side in particular. And they think those effects may actually swamp what happens in other areas. And so I don't want to presuppose anything at this point. As I said to start, I'm worried about everything, but I definitely want to make sure that before jumping to any conclusions, I see precisely what the policies are.
In talking with businesses on the ground, given that consumers are fed up with inflation, probably not going to be tolerant of more price increases, when we do see tariffs, do you think they will get passed on to consumers, or businesses are going to be forced to eat the majority of that? And what does that mean for the overall inflation picture? Does that get bottled up sort of in the supply chain, on the business end at the expense of profits? How do you see that playing out?
Well, this is a question we've been asking everyone because the notion that there would be tariffs have been out there for a while, and we wanted to get a sense of what people are thinking. So in our surveys and in our conversations with leaders, we've asked them what are they likely to do. And what they've all said is that our first best choice would be to pass on this to the final price. But I would just say, and you noted this as well, we've already had a period of intense inflation. Consumers may not have an appetite to do that. So we will have to see sort of how that interplay occurs, and that'll really determine what the final outcome is. I do have a sense. I talk to a lot of business leaders as well, and what they tell me is that their customers are pretty much tapped out. So there is some uncertainty about what the final landing point is going to be. I think it's actually quite different than what we saw in 2017 when we hadn't had that inflation and consumers had a little extra space to be able to take on some price.
So are you worried that you should be more restrictive now? Do you think you cut too much last year?
So I don't think we've cut too much. Look, I think we are still in a restrictive posture. That's what we need. And as inflation gets closer to our 2% target, the ideal way for our policy to move forward would be for us to get to our neutral level right at that point. That would mean we couldn't wait until we got all the way to 2% to start reducing our rate. So what we've done is appropriate. Now, of course, now we have to see sort of what that means for how the economy is going to evolve. And that's what we're doing now. It's one of the reasons why I've been really comfortable with the idea that we would take a pause and wait and see how the economy is evolving, and then use that information to guide what our policy should look like over the next several months.
Just to your point, you've said that you want more clarity on policy changes before deciding which direction to go with policy and how fast. But given that this administration is constantly going to be rolling out policies over the course of this year, what is the prospect that you remain on hold for this year entirely and that there aren't any more rate cuts this year?
So I don't have insights as to all the things that the administration may roll out. And if it is a year, then I think what would happen is that it would be take a longer time and it'd be slower for us to get all the way back to our neutral level. But I don't know what the future will hold, and I'm just going to be ready to take it on board as things happen. I do expect that we'll
still on the table?
Say that again?
So cuts are still on the table?
Sure. Everything is on the table at every meeting. I do think that I go into every meeting open to the possibility that we might take any kind of action based on what the data at the time are. So I'm not taking anything off the table. I'm not putting anything extra on the table. I would just say that we're going to let the data guide how my team looks at it, and then I'll go into the meeting with a view based on that as to what the appropriate action would be.
The minutes also noted that some officials are in favor of slowing the balance sheet or perhaps even pressing the pause button if we were to see any hiccups surrounding the debt ceiling. Are you in that camp? What are your thoughts on that? How did that discussion sort of play out within the meeting?
Well, look, first, I want to say I'm very supportive of the idea of getting the balance sheet down in size away from its emergency level. And we've made good progress on that. The reality is that as we do reduce the size of the balance sheet, we get to that threshold level. There's some threshold level where we're not going to want to reduce it any further because it'll affect volatility in money markets and other things. I think we're getting to that level, close to that level, and there's not precision on that. And given that, I think it's going to be appropriate for us to be more cautious today and moving forward than we have been in the past 6 or 8 months. The debt ceiling is one factor that comes into that, but there are others as well, including how banks decide to deploy capital across their investment instruments. So this is something I want to look at more broadly and make sure that we are paying attention day to day and make sure that we don't go too far and create volatility in the marketplace that could potentially be avoided.
Retail sales contracted nearly 1% in January after a strong holiday shopping season, the biggest drop in nearly 2 years. But is January's decline just seasonality at play or an indication of a slowdown among shoppers? Joining me now, we've got Sucharita Kodali, who is the Forrester Research retail analyst here. Sucharita, great to have you here and grab some insights as well, as always. Just take us into your thinking around this retail sales miss that we saw.
So these numbers are very deceptive, and I just encourage everybody to be extremely cautious in how you look at them, because what it is essentially the numbers from December to January that they are comparing. As an analyst, what I look at is January to January numbers. So when we're looking at year over year numbers, the numbers are actually incredibly strong. And we saw almost a 5% lift in this January versus January sales in 2024. And even when you normalize that for inflation, that is still growth. And that is part of the reason that the economy is still hot. Consumers are still spending. Spending on cars, as an example, is at a record high. Cars have virtually no inflation right now. So people are clearly spending on big ticket purchases, even in spite of higher interest rates. So I don't think that looking at the numbers, the month over month numbers, are all that interesting. Literally what it is they are comparing the change from December to January this year versus December to January last year. And of course, there's going to be some issues related to fires and floods and, kind of natural disasters. But if you're looking in the aggregate at the year over year numbers, they're incredibly strong.
And so I want to go further into your category analysis as well here, because on face value, we would see most categories declined on a month over month basis, but food and drinking services, they were an exception, rising nearly 1% from December. So what does that tell us about what consumers are prioritizing in their spending habits right now?
Well, they seem to be prioritizing just about everything because virtually every category has been growing this year versus last year. There were some larger big box type of general merchandise products like sporting goods and toys that are a little softer, but apparel is up, food is up, grocery stores are up, gas is up. Of course, automotive, as I'd mentioned, is up. So almost every category is doing well. Now, one highlight that I did think was interesting that was softer than I've ever recalled seeing it is non-store retailers. And that is essentially e-commerce and all of the online purchases that we've historically been doing. Now, that suggests, are we hitting a wall with respect to e-commerce penetration? Possibly. Are people just going back to stores and purchasing in physical stores? And that's definitely what we're seeing. Is that a permanent trend? Is that something that sort of has sort of stabilized the shift from offline to online? I think we may be seeing it right now.
And so with all these things in mind, there were some, of course, larger factors that we have yet to see the full impacts from, everything from natural disasters to even larger employment shifts as well. How are you running the calculus early on around what those events actually might hold for future readings?
The impact of those one-time events is often regional, particularly when we're talking about natural disasters. They tend to be regional. They tend to affect certain retailers and certain types of stores in certain regions. And generally, they are not long-term effects because you generally see a rebound. It's not unlike a culture war issue that may impact a retailer in a given quarter, but typically there's a rebound or a privacy crisis or some sort of a data breach. It's similar in those ways. Now, when we're talking about unemployment or some of the macro factors, there are other usually exogenous factors, like the dollar channel, for instance. In spite of the economy doing pretty well, usually you would expect a company that is competing on price and value to do very well. But though that channel has other reasons, like, for instance, the over diversification of their stores, they grew too fast over the last few years. So we're normalizing a bit of that behavior. But it's for the most part, I don't usually incorporate these one-time events into, kind of assuming that that's going to have an impact for years and years to come.
Consumer spending saw its biggest drop in over a year in January, falling 0.9%, well ahead of the 0.2% decline that was expected. Morning Consult's price sensitivity index reached a high of 16.7 for January. The higher the number here, the more sensitive consumers are for prices. Here to break down what this tells us about the health of the U.S. consumer, Sophia Baig, Morning Consult economist. Sophia, great to have you. So let's talk about this price sensitivity index, because this is why I wanted to bring you on the show, is to get a sense of how sensitive consumers are to this inflation. It's at a record high, your index, but 16.7, that's not all the way near 100. That seems like it could be worse. Put this number into context for me.
Sure. So I love this index because it gauges how consumers react to higher than expected prices. We've been tracking it since early 2022, right before inflation started to surge to those highs in mid 2022. And back then, for context, the number was just a few points above zero. So over the years, we've seen that tick up slightly more and more and more as consumers become more fatigued with higher prices. And the way it works is we ask consumers every month about various categories for goods and services that they may have purchased, if they considered purchasing it, and where they measure the price. Was it higher than expected? Was it lower than expected? And then what did they do? So when they walk away more, we take the difference between those shares. It's a little bit complicated of a calculation, but it's pretty intuitive. So when more people are walking away, then we actually have higher price sensitivity scores. And that's what we see today with a high price sensitivity score across many goods and services, the highest we've ever seen this January.
And talk to me about what we know about which areas consumers are making that decision to walk away in. Are there certain non-negotiables, I imagine, like groceries versus other potential kind of wants but not needs that consumers are more willing to walk away from?
For January, we saw kind of a broad-based increase, especially for several durable goods like household repairs, supplies, and exercise equipment, as well as various services that are discretionary, as you mentioned, vacation-related services, restaurants, etc. But groceries, we actually saw a decrease in price sensitivity, which sounds kind of counterintuitive when you think about egg prices, but it kind of makes sense also because groceries, as you mentioned, are something that are essential for people to purchase. They need to purchase them anyway, even if they are running into higher than expected prices. So as the consumers are running into higher than expected prices with eggs and other groceries, they're more likely to just have to deal with it. Whereas for vacations, they can make that trade-off and decide to not purchase the vacation package.
And how are consumers feeling about goods versus services inflation? Because we do know that goods inflation has been relatively sticky, and now we're starting to see services inflation picking up.
So services inflation has been that thorn in the side for the Federal Reserve, and it makes it difficult for consumers as well. Right after the pandemic, closures began to reopen, people really demanded those services and wanted to go on vacation, wanted to go out to eat. But now that the prices have been increasing more for services versus goods, consumers are feeling a little bit more fatigue there. And goods has been a big helper for consumers and for that top line inflation number. But we're starting to see that sort of reheat a little bit more, especially now. It could be even worse with the threat of their tariffs putting some upward pressure.
Yeah, we've certainly been talking about the policy impact this morning, but we've also been talking a lot about corporate earnings, and we're heading into Walmart earnings here coming up. Talk to me about what you know about consumers shifting to lower price retailers and how that could impact companies like Walmart.
Yeah, so we also have a substitutability index, and that has been heating up a little bit as well at the end of 2024. And we see that especially for lower income consumers. So we also see that for high income consumers. So sometimes when people shop at Whole Foods or maybe more expensive grocery outlets, they might substitute down to Walmart and decide to buy there instead. So that could be positive and bullish for Walmart.